Good afternoon and welcome to Matters Financial and Geopolitical from a Frontier. Let me read you my weekend piece first. The headline was Bond Yields in Tilt Mode. G7 government bond yields have sunk to record lows. The iconic German Bund 10-year German bond sank to minus 0.21%. The German Finance Ministry receives 20 cents per 100 euros of debt as a gift from the investors when they sell 10-year bunds. In fact, Switzerland is experiencing negative bond yields through 20 years, Japan, Germany, Denmark, Netherlands through 10 years, Austria, France, Finland 8 years, Sweden and Belgium 7 years, Ireland and Slovakia 6 years, Spain, Portugal, Slovenia 5 years, and even Italy's 6-month bills are negative. Of course, Japan was the first G7 to enter tilt territory, and its JGB, the Japanese 10-year bond, remains at negative 0.1%. This macro gale force level move has pulled US 10-year treasuries to a 20-month low of 2.15%. Last November, it was at 3.24%. Rate markets in the US have now priced in close to 85 basis points cumulatively of easing by the end of 2020. That's from JP Morgan. The US curve has inverted, and typically curve inversions are harbingers of recession. Markets and prices exhibit patterns of correlation, and essentially my perspective is that it is the correlation that has exerted a pull effect on US yields, and that therefore the recessionary signaling of the yield curve should be discounted. There has been a strong safe haven demand develop over the last few sessions, which has lifted government bond prices, gold, and the yen. And there is a correlation element to yen strength. Japanese bond yields were already negative. Therefore, in the comparison, Japanese yields have become more attractive, and this has given further muscle to the yen. It was not too long ago that everyone was predicting a Weimar Republic outcome, or if you are looking for a more recent vintage than dial-up Caracas, Khartoum or Harare. Classical economic theory predicted that if lashings and lashings of freshly printed money were injected intravenously into the patient, then the value of money should devalue and inflation run off the charts. Clearly, this has not happened. In fact, inflation gauges are slumping, and inflation is like a patient etherized upon a table. Trump's tariff war has spiked earlier hijinks. Stock markets have lost ground, and investors have continued to run for cover and safe havens. You will recall Ben Bernanke's riposte when asked why investors buy gold. People hold gold as protection against what we call tail risks, really bad outcomes. Gold crossed 1,300 on Friday. It's now at 1,317. Crude oil got crushed 5.34% on Friday, capping a 15.87% retreat over the last 4 weeks. But we're up 1% this morning. Crude oil is an interesting proxy because it's been a tug of war between sharpened geopolitical risk, particularly in the matter of Tehran, which sent prices higher, versus concerns around global growth, and the latter has now overwhelmed the former. It has turned out that it was not April that was the cruelest month, breeding lilacs out of the dead land mixing memory and desire, stirring dull roots with spring rain, but May. The trade war intensified through May, and its intensification is best perceived through the linguistics. What we also know is that you don't stand in front of a runaway freight train. The question we need to ask ourselves is how much further this move may run. My sense is that the G7 bond markets are now in nosebleed territory. Whilst I accept that it's a 2080, US consumer absorbs 20%, China will have to absorb 80% of the tariff price increase. Nevertheless, even 20% of 100 is inflationary. The US rates and bond market look seriously overcooked to me. However, what we also know is that markets can stay irrational longer than anyone can stay solvent. Therefore, I would be tentatively selling 85 basis points of cumulative US easing through 2020. Last week we saw positive EM and frontier market divergence, which was noteworthy. Lusaka is in unprecedented territory, and the forced nationalization of Mr. Agarwal's copper mines might well be a cashew nut moment for President Lungu. Zambian dollar Eurobond yields are at 22%. That's whack. Let me end with the Madaraka Day masterstroke announcement. I am sure the central bank has visibility on how much cash is not in circulation. The announcement might be a catalyst for a short-term stimulus, as owners of the Jirongos, if I remember correctly. The 1,000 shilling note was first released in the 1990s and was known as a Jirongo. I would have thought the discount is already 20% at the very least. Demonetization is a very neat solution. Muhammad Weliye, who will be my guest this evening on Metropole TV, says it is a one-time tax on black money. Counterfeiting of 1,000 will go down. CBK liabilities of Kenya shillings down, as a certain percentage of the demonetized 1K will be extinguished, not come back. Cash to GDP ratio will go down. Percentage of big denomination, Ray money in circulation down. I thought it a very clever move, and I noticed that the president was rather amused by it as well. May was a big risk-off month. That's why I said April is the cruelest month. May was a big risk-off month, with this trend accelerating over the last week. Deutsche Bank data highlight. Global yield curves blare louder alarms about economic prospects. In the US, the 3-month T-bill yield on Friday exceeded the 10-year note by a margin last seen in 2007. Germany's 10-year rates plunged to a new record low, well below zero. Britain's yield curve is around its flattest since the global crisis more than a decade ago. This is from Holger. Germany 10-year yields hit fresh lifetime low. 3-month US Treasuries, 2-year US Treasury spread 40 basis points, a 2.1 standard deviation event since 1985. Rate markets pricing in even more Fed easing. 1-month OIS curve is now pricing in almost 2 rate cuts by the end of this year and close to 85 basis points cumulatively by the end of 2020. I'd be looking to short that now, small size, just to see how we get on. 10-year Japanese government bond yields at their lowest since March, near minus 0.1%, but they've been around here for a very long time, and that's the point. Everything else has come down towards it. Dallas's Fed gauge showed underlying inflation rose to 2% in April, and that's why I think the market is overestimating the amount of rate cuts, because these tariffs are surely going to be inflationary in some shape, way, or form.